AI Forex bots promise the world. Most are overfit junk. Here's where AI actually helps you.
If you've ever searched AI Forex bot, you've seen the pitch. 99% win rate, set it and forget it. $200 a month and the machine trades for you. Here's the part the marketing never says out loud. The one thing those products promise, live price prediction, is the single task AI is worst at in Forex. And the 4 tasks AI is genuinely great at, almost nobody is selling those. So let's pull this apart properly. By the end, you'll know exactly where AI saves you hours a week, where it quietly drains your account, and how to spot a fake bot in under 60 seconds. First, the confusion. AI for Forex is not one thing. It's 4, and the marketing industry deliberately blurs them. 1. Generative AI. ChatGPT, Claude, Gemini, large language models you type into. 2. Machine learning trading systems. Real statistical models trained on price and macro data. 3. Expert advisors with AI stickers slapped on. Rule-based MT4 and MT5 algorithms rebranded to ride the hype. And 4. Institutional execution tools used by banks and hedge funds to route orders and manage risk. When a landing page says AI Forex, ask which one. The honest answer is almost always category 3, a recycled EA wearing an AI costume. That distinction matters because the first category, generative AI, is where retail traders are leaving real money on the table. Here's where it actually helps. Macro research. Central banks publish dense, deliberately careful statements. FOMC minutes, ECB press conferences, rate decision wording. The job of a junior macro analyst used to be reading those line by line and flagging what changed. That job is now zero marginal cost. Paste this month's FOMC statement next to last month's. Ask the model what language shifted and what it implies for the rate path. Paste an ECB transcript. Ask for the 3 most market-moving phrases. 2 minutes. Done. The trader still owns the judgment call. The model just removes the grunt work. That's the pattern for every productive use of AI in Forex. It does the reading, you do the thinking. Second productive use, code. If you're building expert advisors or running Python backtests, LLMs cut development time by 50 to 80%, translating a strategy from English into MQL5, debugging off-by-1 errors in order management, catching misrounded lot sizes, writing data pipelines for tick data. One rule though, never paste account credentials or live API keys. Generate the code, test it locally, then deploy. Third use, journaling. Feed 100 trades into a model and ask which day of the week has the highest expectancy. Ask which setup has the worst average loss. Ask it to flag every trade where you held a loser past your plan. The model is a patient, fast analyst that never gets tired of your spreadsheet. The catch, it's only as good as your journal. Garbage in, polish garbage out. So that's the good news. Now the part everyone wants AI to do, and the part it does worst, live price prediction. Here's the mechanism the marketing pages never explain. Forex price data is non-stationary. The statistical relationships that held in 2022 are not the relationships that hold in 2025. A model trained on the rate hike cycle of 2022 will mistrade the cutting cycle that follows it. Regime change eats backtests alive. On top of that, signal to noise on majors is brutal. FX returns at short horizons look almost like a random walk. The biggest banks in the world measure their FX trading Sharpe ratios in single digits, not double. And retail backtests rarely cross-validate properly. A model with 200 features and 5,000 hourly bars will fit the noise perfectly. You get a beautiful equity curve in testing. It vanishes the moment it touches a live spread. And that's the killer detail, microstructure. Retail spreads and slippage eat the entire edge. A signal worth 0.4 pips per trade is worth literally nothing on an account with a 0.8 pip spread. The math is already lost before the model places the order. So if hedge funds with 9-figure infrastructure budgets struggle to extract a Sharpe of 2 from FX, what exactly is a $97 a month bot offering? 3 options. It's overfit, it's curated, or it's fraud. Which brings us to the 60-second filter. Honest AI products show verified live track records, 3 to 5 years on MyFXBook or live broker statements. They publish their worst 1-month drawdown. They disclose what the model trains on, and the firm behind it is registered with a Tier 1 regulator. Red flags? A win rate above 90%. Backtest screenshots only, no live results. A track record that starts conveniently after the worst drawdown. Proprietary AI with zero methodology. Telegram chat room. Crypto payment. Offshore entity. If you see that combination, close the tab. Here's the tell. The honest products, the rare ones that pass that filter, show sharp ratios of 1 to 2, drawdowns of 10 to 30%, annualized returns of 10 to 25%. That's what a serious algorithmic strategy actually looks like. It's a long way from 99% win rate. And that's the answer to the question I asked at the start. Why did the honest products show 20% a year when the pitches all show 99% win rates? Because 20% is what's mathematically possible in this market. 99% is what's marketable. One reflects Forex, the other reflects a landing page. So here's the workflow that actually uses AI well in 2026. Pre-market. Paste overnight headlines and the economic calendar into a model. Ask for a 30-second briefing and the 3 biggest event risks. Setup screening. Stay rules-based. Forex Factory, TradingView. AI doesn't help here. Execution. Manual or a rule-based EA. No live model in the loop. Post-trade. Journal everything and once a week, ask a model to find your patterns. Code maintenance. Debug your EAs with an LLM. Test on demo, then deploy. One last piece, the regulation. Running an EA or any algorithmic system through a regulated broker is fully legal. The FCA, ESMA under MiFID II, the CFTC, and NFA in the US all have frameworks for this. But read this carefully. Those frameworks apply to the broker, not to you. You carry full responsibility for what your algorithm does, including the losses. The broker is not your kill switch. You are. So here's the verdict. AI changes which tasks are cheap, it does not change which tasks are profitable. Forex is hard for the same 3 reasons it's always been hard: low signal to noise, regime change, and microstructure costs. AI erases none of those. Use it for the 4 jobs it dominates: research, code, journaling, and pattern detection on your own trades. Never for live signals, never from a Telegram channel, and never without a verified track record. Get that separation right, and AI becomes the most useful junior analyst you've ever hired. Get it wrong, and it becomes the most expensive one.
Use AI for research, code, and journaling. Never for live signals. Full breakdown linked in the description.